Okay, close our eyes for just a second and think about a roaring bull market. We've all been there, right? Investors feel super confident, everyone is excited. I mean, when the market is just going up day after day, we all feel like absolute financial geniuses. We feel totally invincible. But unfortunately, that feeling is usually an illusion. You see, market crashes don't just test your money, they test your psychology. So today we're stripping away the hype and looking at the raw, unfiltered reality of market crashes. Our goal in this explainer is to build up your resilience for when the inevitable actually happens. Because bam, instantly that illusion breaks. The sudden, totally jarring reality of a crash sets in. You log in, and suddenly your entire portfolio is painted in this deep, ugly red. Mutual funds are dropping daily. The news channels are literally screaming about impending doom, and social media just becomes this toxic echo chamber of negativity. It leads to sleepless nights, and you find yourself checking your portfolio obsessively like every 10 minutes. So we really have to ask, why is it that most people make their absolute biggest, most destructive financial mistakes during these exact periods?
Well, let's dive into part 1, the anatomy of a crash, and understand exactly what triggers these events.
To figure out why we panic, we first got to look at the actual mechanics of a sudden market plunge. Look, crashes almost always have a logical starting point. We're talking about macroeconomic triggers here. Severe economic slowdowns, sudden spikes in inflation, aggressive interest rate hikes by central banks, unexpected wars, or maybe a banking crisis. But here's the real secret. Sometimes markets crash due to fear way before the actual economic damage fully plays out. Markets move on expectations and human emotions, not just the current reality. The economic trigger might start the descent, but fear? Fear completely yanks the steering wheel.
And man, that fear spreads like a virus, which brings us to herd mentality. When that initial trigger happens, it quickly snowballs into a psychological cascade. Humans are hardwired to look at what the group is doing just to survive. It's biological. So when you see heavy selling, huge red candles on the charts, and institutions rushing for the exits, the herd just starts running. Retail investors stop trusting their own research and just blindly follow the panic. And that causes prices to free fall even faster than the underlying fundamentals could ever justify.
There's just this visceral shock to seeing a number like -30%. Imagine logging into your mutual fund or stock portfolio, something you've spent years painstakingly building, and seeing a sudden, massive drop like that. A 20 or 30% correction literally feels like a physical punch to the gut. This level of shock often triggers automatic stop losses and absolute, blind panic. People who proudly called themselves long-term investors just a few weeks ago, suddenly they want to liquidate every single thing they own. And honestly, this brings up a pretty brutal irony of human psychology. Just think about it for a second. The exact same stocks that people absolutely loved at higher prices suddenly feel incredibly dangerous at lower prices. The actual business? It probably hasn't fundamentally changed at all, but the price tag did. And suddenly, our brains perceive it as a massive threat rather than a bargain.
So let's unpack that in part 2. The psychology of panic selling, and look at what happens inside the brain.
This brings us to what is perhaps the single most important concept in our entire explainer today. Listen closely. When the market drops, your portfolio value is down on paper. It is temporary, but the human brain naturally craves safety during periods of heavy uncertainty. When you act on that fear, when you actually hit the sell button just to stop the pain of watching those numbers drop, you lock in that catastrophic damage. You've taken a temporary dip and made it entirely permanent.
We really have to clearly separate these two concepts in our heads. Temporary volatility is a feature of the stock market, okay? It's not a bug. It's just the normal ebb and flow, the short-term market swings. Permanent loss, however, that happens when you exit at the absolute bottom out of pure fear. Or, if you were blindly holding fundamentally terrible investments that were never going to recover anyway. Look, long-term equity mutual funds follow broader market movements, which means volatility is just expected. If you panic sell, you literally never give your capital the chance to experience that inevitable rebound.
Which naturally leads us to part 3, what smart investors do, and how they see opportunities where others just see disaster.
Consider the stark contrast between these two mindsets. Think about the panicked amateur. They're reacting totally emotionally. They stop their SIPs, they act entirely on fear, and they are practically torturing themselves by checking their portfolio constantly. Now contrast that with the smart investor. They understand that markets naturally move in cycles, and the corrections are just part of the game. They maintain their discipline, keep their emotions entirely in check, and actually use the crash to accumulate quality assets at much cheaper valuations. They know deep down that good businesses always recover over long periods.
Let's look at how this actually plays out in practice with a systematic investment plan, or an SIP.
Smart, long-term investors do not stop their ongoing SIPs when the market crashes. No way. They know that when the net asset value, the NAV, drops, their fixed monthly investment amount actually buys them way more units of that mutual fund. They are accumulating a much larger share of the asset at a massive discount. This lowers their average purchase price across the board and sets them up perfectly for exponential compounding when the market eventually turns around.
Now, let's zoom out a bit for part 4, historical recoveries and resilience, because historical context is everything.
Let's trace this timeline, because it pretty much always follows the exact same pattern. First, we have an economic boom that lasts for years. Then, some global crisis or uncertainty hits, creating heavy tension for months. This triggers the market crash, which happens violently and rapidly, usually over just days or maybe weeks. But look at what always follows: a slow, steady recovery over years, which ultimately leads to brand new market highs over the decades. History clearly teaches us that despite wars, recessions, and global crises, strong economies and quality businesses have historically always recovered. Short-term volatility is literally just the toll you pay to travel the road of long-term investing.
So, let's get practical with part 5. Biggest mistakes to avoid. Let's build your ultimate survival guide.
Here is your concrete step-by-step roadmap for when things get ugly. Step 1, maintain an emergency fund. I can't stress this enough. It is absolutely critical. If you have 3 to 6 months of living expenses saved in cash, you will never be forced to panic sell your investments to cover an unexpected bill during a crash. Step 2 is having proper asset allocation based on your personal risk tolerance. Step 3, avoid blind averaging. Don't just throw good money after bad simply because a stock looks cheap. Only buy more during a crash if the underlying business or mutual fund is fundamentally strong. And finally, step 4, continue your SIP discipline. Just turn off the scary news, log out of your brokerage app, and let the system do the heavy lifting for you.
So the crucial point we've been building toward all along is exactly this. Crashes feel terrifying because money, fear, and uncertainty all combine together to completely strip away our rational, logical thinking. But in the markets, surviving emotionally is often far more important than trying to predict the exact top or bottom perfectly. You see, true wealth doesn't go to the fastest reactor. It goes to the most patient observer. As we wrap up this explainer today, I want to leave you with a pretty serious question to think about. The next market crash isn't a matter of if, it is 100% a matter of when. It's just a totally natural part of the economic cycle. But when that day finally comes and the screens turn bright red, you now have the psychological blueprint to actually survive it. So will you be the one locking in permanent losses out of pure panic, or will you be the disciplined, smart investor quietly accumulating great assets while everyone else is running away? Ultimately, that choice is entirely up to your mindset.